But what we're seeing with all of this evidence, if you sell a home, it's more affordable to rent right now. And so you rent while you're invested in gold and silver, and then you buy once the price of homes has come down by 80 or 90% measured in silver, so that you can buy 5 or 10 times more homes and have all of this rental income from cash flowing real estate. Throughout human history, gold protects your purchasing power. And right now we're in one of these cycles where the safe haven asset becomes the asset class with the maximum potential gains in purchasing power. So these are rare moments in history, very rare. Hi, everyone. Alan's got a great presentation that sort of continues the information that I was giving you on the update about the state of the economy currently. And this continues. In that previous video, I focus on real estate near the end of it. And this continues showing us what all the troubles with real estate are right now. So, Alan, why don't you hit me with your presentation?
Yes, will do, Mike. Well, it's basically good news for gold and silver investors because purchasing power for them is increasing and purchasing power for everyone else is decreasing. And that's really the story of the economy. And as we look at real estate, we have a great chart here from Nick Laird of goldchartsrus.com. And he's got the housing price measured in ounces of gold. So how many ounces of gold would you have to spend to buy a house? And in general, it's getting cheaper and cheaper and cheaper, but we're still not at the peak. So anyone who's holding gold is seeing their purchasing power going up, measured in houses, but there's still a little bit more to go.
Right. So this is basically house price inverted because it's in gold. So gold's maximum purchasing power, and the home is super cheap when it goes down to the bottom. And we looked at this a little bit and discussed it before the video here. And you looked very closely at this, and it looks like there's about 12 data points per year. And so this is a monthly chart, putting the peak of gold at around $600 or $650, not $850. So that spike at the bottom at 1980, where homes become super cheap measured in gold, actually goes much lower than what it's showing, probably down to 50 or below, right?
Yeah, I would think so. Yeah, I'd have to do some more math around it. But yeah, absolutely. So what gold holders should expect is that their purchasing power might continue to double to approximately meet, the purchasing power back in 1980, measured in houses. So absolutely,
Right.
However many houses you can afford now, you should be able to afford twice as many if you keep holding gold.
Yeah, except I do want to say that it should probably go down to that area if we had 33% debt to GDP like we did in 1980. If the stock markets were super undervalued like they were in 1980 with PE ratios of like 7, 8, 9, 10, where a brand new bull market is just forming instead of one that is hyper overvalued and overextended and about to crash. This time, I believe that we're going to blow way past that 1980 spike down on the bottom. So when you're looking at the value of your gold compared to real estate, you sort of, in your mind, have to flip this chart upside down. Those are the gains in value that your gold is making against real estate. This is how cheap a house is becoming if you're owning gold. So, yeah.
Exactly.
Any other comments on that?
Yeah, no, I think you said it. And basically, this is about the purchase price of the house. I also want to look at the monthly payment that you'd expect to make, because I did that calculation a few months ago. I just want to remind our audience, or maybe show people for the first time if they're new to the channel. What you see here in the red line, let's look at the red line. This is the monthly payment you'd have in dollars, okay? And this is taking the median sales price of a home in the US and the 30-year fixed rate that people are paying nationally, and basically calculating what that monthly mortgage payment would be. And that's the red line. And you can see it rose a lot in the 70s after we unpegged the dollar from gold. And then it rose a lot right after 2020, basically when fractional reserve lending completely disappeared and infinite cash could be created. So things are getting out of hand. However, when you measure it in gold, it used to be 3 or 4 ounces of gold per month, and now it's down here below 1 ounce of gold per month and getting cheaper. So again, we see the same
Right.
story playing out. If you're paying in dollars, things are getting more and more expensive. If you're paying in gold, things get cheaper.
Yeah, I do want to point out for everybody that you made this chart a few months ago, you said.
Yep.
And so it's before gold rose from like $3,300 up to $3,800.
Yeah.
And so it doesn't have that data in it. And that means that that yellow line just fell below we're probably at like less than about half an ounce of gold now,
Yeah.
something like that for a mortgage payment. And so, it just shows you that, throughout the centuries, period, throughout human history, gold protects your purchasing power. And right now, we're in one of these cycles where the safe haven asset becomes the asset class with the maximum potential gains in purchasing power. So these are rare moments in history, very rare.
Absolutely. Absolutely. And it's not just gold, it's also silver. So let's look at home prices measured in silver. How many ounces of silver would it take to buy a house? Right
Wow.
now, it's about 10,000 ounces of silver. But in the past, it's been as little as maybe 2,000, something like that. So we could see the purchasing power, of silver increase fivefold easily from where it is today. So a lot of gains still left on the table.
Okay. Well, you did a chart recently of how many days silver spent above $40, and that this is monthly data. So that spike actually goes much further down to the bottom of the chart than what you're seeing here. This is monthly data, not daily. And then on top of that, back in 1980, when we had that spike, there was a lot of above ground silver. There were enormous government stockpiles still. The economy wasn't in trouble. Like I said, debt to GDP and all of those fundamentals. And we didn't have the entire world is about to rush into the precious metals to protect. Like in China, it's already happening. The West, for some reason, has been totally asleep. And it's really too bad that people weren't jumping on gold a couple of months ago before the last big rise. It's really too bad that people weren't jumping on silver back when it was $20 instead of $47. We are about to break that $50 barrier, and it's going to be in the news over and over and over again. And you're going to see this very rapidly, especially if it's coincident with, in 1980, real estate wasn't in a hyper bubble. And it is today. It's in a gigantic bubble. And if silver is going north at the same time that real estate is crashing, we could see a day come where less than half the amount of silver is required to buy a single family median price home versus this chart in 1980. So, this chart says that you probably have 5 times gains. In other words, you could sell a house today, invest in silver, and if you are able to nail the peak, you'd be able to buy 5 homes with the proceeds from your silver. Well, it's probably going to be more like 10. That's my point, because the fundamentals are there this time. So anyway, okay, let's...
Yes, so that could even be 1,000 ounces of silver, right? A 10x move from here is 1,000 ounces of silver. That's 2 monster boxes. A lot of people have 2 monster boxes, so
yeah, right.
That's
right.
doable. That's doable.
It is doable.
Yeah. So what I
Okay,
have here,
and it's just math, and then you take what happened before. So it's a repeat of history, adjusted for inflation, and then you add the difference in the underlying fundamentals. Real estate was not in a bubble. The stock markets were way undervalued, and gold and silver went into a hyper bubble. This time, gold and silver are going to go into a hyper bubble, but real estate and stocks and bonds are also in hyper bubbles, the biggest in history. And when those bubbles pop at the same time that gold and silver are going north, you're going to see some amazing priced in gold, priced in silver, fire sale prices on everything: stocks, bonds, which you probably don't want to touch, and real estate, which you probably want to consume as much as possible. Get fat on real estate.
I can't wait. Our next chart here, renting is now significantly more affordable than buying a home by one of the widest gaps ever recorded. So we can see here,
Wow.
the dark blue line, the
It is.
rent to income ratio, and the light blue line is the mortgage payment to income ratio. So you can see that owning a home got significantly more expensive, like twice as expensive, or I'm sorry, it's not a true zero, so it's not twice, but significantly more expensive than renting, and it's happening again now. So that was the same as the global financial crisis. And are we having another
But
crisis
now we're
now?
way up past the peak of the global, we're way up past the peak right now of the global financial. Well, that wasn't the global financial crisis. That was the peak of the real estate bubble. That's above, it's like 32, I guess, on this chart, or 30, yeah. But we're above that. We're up at like 30, well, 32. We're up above it just slightly. But the thing is, to be up above the 2006, 2007 real estate bubble that led to the global financial crisis when we weren't in a stock market bubble, this is something amazing and scary at the same time.
Exactly. And if it comes down, I mean, what is going to cause it to come down? Like something has to give, right? Something has to crash. Things have to move fairly rapidly to bring back into balance. So we'll see what happens.
Yeah. Okay.
Our next chart here, home prices need to fall 40% or incomes need to rise 60% just to return the housing market to 2019 levels. Generational crisis. So let me elaborate on that by reading this paragraph here. According to Fannie Mae calculations, okay, government numbers.
Wow. Government agency, basically, one of the government-sponsored entities.
Yeah, but
Fannie Mae.
all the government numbers are wrong anyways. Now, okay, let's use their numbers.
Right, but when they fudge things, they try and make them look better.
Yeah,
and this thing is sort of bad news for the economy. Go ahead.
exactly. Let's see how bad they admit that it is, and maybe it's even worse. So, according to them, it would take one of three things, or a combination of them, for affordability, housing affordability, to return to the 2016 to 2019 levels. Okay, here are the three things. Either the median price of a single family home would need to fall 38%, 38%
Whoa.
to about $250,000. Okay, that would have to happen to make houses affordable. Or median household income would have to rise more than 60% to $134,000. I don't see that happening. Or the third thing, the mortgage rate would need to fall to 2.35% from roughly 6.5%, where it is today.
Okay, looking at this, this is just an opinion, so take what you will from it. But I feel like the only one that could possibly happen and will most likely happen is that all of the real estate will fall. We are in for a crash because that is what is in a hyperbubble. Right now, incomes are depressed, but if you go into a crisis, and there is one brewing right around the corner, incomes do not rise in a crisis. Unemployment rises. And so I have a feeling it's probably going to be bigger than that 38%. We're going to see something similar to the global financial crisis, but even worse because it isn't just real estate. It's real estate, stocks, and bonds. Okay.
Yeah.
What's your take?
Yeah, no, I agree with you completely. I don't see mortgage rates dropping. Not to that extent anytime soon. I mean, we're just in a 40-year, declining interest rate environment. We're probably entering a 40-year rising interest rate environment, despite recent rate cuts. It's probably a long-term rising rate environment. I don't see incomes rising. The only way incomes would rise is as a result of like a lot of inflation, like massive currency creation. But then the price of homes would probably go up even more than incomes, which is exactly the crisis we're talking about, right? Home prices are rising faster than incomes. So, gosh.
Yeah, in the previous chart where you were talking about the affordability as far as rent versus or the mortgage payment. I can't remember what the chart was, but you said something has to give, and it's that fall to 38%. Yes, so rent versus income ratio and mortgage payment versus income ratio. something has to give there. And the only thing that's going to give without the economy getting more screwed up than it is real estate is going to take a giant crash, and it's going to be greater than that 38%.
Yeah,
Okay.
I think so too. And how did we get into this mess? Is it because of massive currency creation?
Wow. Hi, it's Mike here. Just a quick message. I wanted to welcome the huge number of new visitors to our videos, but point out that less than 15% of our viewers have subscribed to this channel and hit the notification bell. We're heading into some turbulent times, so if you don't want to miss any updates, make sure you enable notifications. And thank you as always for clicking the thumbs up button. One more thing. At goldsilver.com, we've been providing top-notch educational content for over 20 years. If you'd like to help us continue this mission, we'd be honored to be your precious metals dealer. It's a win-win. At the moment, you can get up to $2,000 in bonus silver by ordering from us. Check out goldsilver.com in the link below. Thanks, and now back to the video. The median sales price and the M2 currency supply, and look at that correlation since 2020, since the pandemic. Oh my God. I can't believe it. It's
I'm speechless.
This is 100% Jerome Powell's fault and the Federal Reserve and them screwing with the economy instead of letting the free market work. Them and the Treasury, Janet Yellen, this is the blame all lies on the shoulders of very few people. When we experience this next thing, the Bernanke bust, it's Bernanke, Powell, Yellen, and these people that think they're masters of the universe, that think they know more than the free market, the sum total of all the transactions that go on in a society. Nobody has more information than that. And yeah, so this is going to be an absolute disaster.
Yeah, this is what we call a systemic problem. you got to change the system. You got to change the monetary system. Otherwise, it's just going to get worse. Things get more volatile. The bubbles get blown even bigger. The crashes are even bigger over time. It's not pretty. It's not pretty.
Okay.
Our next chart. Home sales are headed for their worst year since 1995. That's 30 years. That's an entire generation and a half. This is the worst year we've had for home sales. No one wants to buy. It's ugly.
Wow. I didn't know that. Amazing.
Yeah, that's according to Redfin. So
well, and that creates downward pressure in pricing.
Exactly.
And we're up in a hyper bubble.
Exactly. So, exactly. Okay. And very fascinating, 54% of Americans, that's more than half, by the way, that's most, said there is no mortgage rate at which they would feel comfortable selling their home. None.
You know what, though? And this is true, but the public is generally wrong. Now is the time to sell your house like tomorrow. If it was me, I do not give financial advice, but I would be selling residential real estate like tomorrow and buying silver and gold in that order. Silver first, then gold, because of the gold-silver ratio. Silver is a screaming bargain. Wow, that's per Bank of America.
Mm-hmm.
Wow.
Yeah. And that's up 12 points from last year. So last year, it was apparently 42% of Americans that said that. Now it's 54%. So that's a huge increase in a year.
Right.
That's huge.
Well, they're seeing the value of their homes go up and up and up. And humans always just take whatever's happening today and project it infinitely into the future. And it doesn't go like that. You and I spent a long time on cycles in a chapter that was cut from our book because it was just it was putting too much space. That chapter ended up being like 100 pages or something. It was ridiculous. But it was really about all of these different cycles that we go through. And people, they haven't experienced a big crash since 2008. So it's been a long time. And so they just think that the past few years of experience, they're seeing how much more it would cost them if they sold a home and bought another one to replace it. But what we're seeing with all of this evidence, if you sell a home, it's more affordable to rent right now. And so you rent while you're invested in gold and silver, and then you buy once the price of homes has come down by 80 or 90% measured in silver, so that you can buy 5 or 10 times more homes and have all of this rental income from cash flowing real estate.
Yep. But the public, to your point, they're usually wrong, and they don't understand the cycles. So
there was a whole chapter about that in my first book. So yeah. Okay.
Excellent. We've got a chart here from Nick Gurley. It currently costs about $800 more per month to buy a house with a new mortgage than to keep your house with an existing mortgage. That is a huge deviation.
It's huge, and that is the reason for the last statement by the public. They got trained by this, but this is about to change, and it's going to change dramatically.
Yeah. So he also says this helps explain why homebuyer demand is so low and why Fed rate cuts aren't re-stimulating demand. Mortgage rates need to be 4% to unlock this market.
So yeah, well, they're going to have to be actually lower than that, which just isn't going to happen. One of the things that you and I did was we did a chart of mortgage rate cycles, and we went back over 100 years of long-term mortgage rates, and we found that there is this cycle. And I actually, when I bought my farm here, I actually pegged the month that I thought mortgage rates were going to bottom, and I did a lease to buy with the cost of the lease being applied to the down payment on the property, and I delayed the actual purchase of the property by about 9 months, and I actually nailed, based on this historic data, I nailed the lowest mortgage rate that's been available in the last 100 and something years.
Wow. Well, congrats.
Right. Sorry about the cough, but anyway, this chart is the reason the public has been trained, and so this big divergence happened in 21 after all of the stimmy checks came out of hiding, and after the Fed, so inflation started to rage, and the Fed raised interest rates because of it, and that caused that divergence.
And in March of 2020, that's when the Fed eliminated reserve requirements completely. So fractional reserve lending went to zero. Banks didn't have to hold any reserves at all. And any reserves they had were considered excess reserves, so they could lend out like crazy. And I think that's what contributes to this divergence as well.
It also, when they stopped requiring reserves, they stopped requiring any vault cash as well. So some banks run very, very lean on vault cash, and that, during any type of panic, that can lead to a very dangerous situation.
Yeah. Yes. Another one, mortgage rates have climbed since the Fed has cut rates on Wednesday. Yikes. That's moving the wrong direction. They are now at 6.25%, up from 6.1%, according to Mortgage News Daily. Not good.
So that means the Federal Reserve has totally lost control of this. They think they've still got, that guy behind the curtain in The Wizard of Oz, pulling all those levers, pushing buttons and cranking little wheels and stuff. The control is completely gone. The curtain has been pulled back, and we've found out that the entire monetary system is a fraud.
Exactly. And that leads me to our meme of the day. We got a talking dog here. He says, I got into the human world to find purpose, but this whole thing is just an elaborate version of fetch.
And for most people it is. I enjoy what we do. I feel like we're helping people. So I don't feel like my life is an elaborate version of fetch. But boy, if I just had a regular grinding job, this would really hit home for me. I want to thank you for this presentation, Alan. It was great.
Yes. Thank you, Mike. Thanks, everyone, for watching. Invest and earn up to $2,000 in bonus silver at goldsilver.com. It's easy. Step 1. Open any gold silver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit goldsilver.com/free silver to claim your silver.